he had a business that was returning excess of 50% on invested capital almost per month. He said that he could pay off a jet ski in the summertime in about 16 days.
Hi, welcome to the Red to Black podcast. Here, you will learn how to invest in highly profitable private businesses to create abundant financial freedom. If this topic interests you, we invite you to subscribe to our channel. This podcast is hosted by Werner Minchel, ex-Marine aviator and current real estate investor, and Mario Parzino, current Marine infantry officer and business investor. Okay, so let's discuss number one, return on invested capital. Can you share with us what that means and how you view it with our listeners?
Absolutely, Warner. So return on invested capital. So it's a numerator and a denominator. So numerator is going to be earnings or earnings power, and we're going to divide that by the denominator, which is going to be something we've pumped into this, some cash we've pumped into this business. We've bought some plant, we've bought some equipment, and we even bought some real estate. So PP&E, I think it's plant, property, and equipment, or property, plant, and equipment. We don't want to turn this into an accounting course. We're just going to generally talk about these terms. And you could go to the library and you could spend 35 cents and read in late fees and read all sorts of accounting books. And that would be fascinating for the autistic nephews I have out here in this podcast realm. But I'm going to try to break this down real simple. So return on invested capital is used to determine basically how good a business is at using its capital to generate earnings. So I've pumped money into the business. I've bought some equipment. I've bought a plant. I've bought some property. I've used some working capital. Think inventory. Think I've paid some employees. Working capital. That's like 1 year or less. Kind of cash that I've deployed into this business. Okay, now that's the denominator. What is the numerator? That's what I got back out of that. So I pumped that in for 1 year. What did I get? No, we're not going to use revenue. That doesn't make any sense. And we're not going to use net income because that also doesn't make any sense. We're going to use something called operating income or earnings before interest and tax. So EBIT, earnings before interest and tax. That's our numerator. And our denominator is going to be an accounting term, basically invested capital. So how do we come up with invested capital? Okay, so we're going to take net working capital. So think of like all the capital that's being used in the business in a year, plus net fixed assets. So it's not intangibles, it's not goodwill, it's not these funny accounting terms. It's actually hard and fast what's on the property, what's on the ground. So it's all the trucks, it's all the trailers, it's all the equipment, it's the plant. It's the property. So net fixed assets. So start with net working capital plus net fixed assets and subtract excess cash. So that's cash and cash equivalents and marketable securities and all the other stuff in the accounting equation that doesn't have to do with working capital. That's going to give us invested capital. That's a number. That's your numerator. And then we're going to divide that by earnings before interest and tax, operating income. All right, Warner, over to you.
Okay, so why is that ratio? Why is that important for an investor? Why do we want to know if we invest in the business what our returns are?
Okay, I have a story to tell you, Warner. I met a dude in North Carolina, and he had a wonderful business. I was fishing under a bridge it connects Wilmington, North Carolina to Wrightsville Beach. It's called the Causeway Bridge. It's actually a bridge that opens up to allow massive yachts that are coming down the ICW from New York, Connecticut, et cetera, to transit the intercoastal down to like Miami. So it's got excellent sheep's head fishing, which is the poor man's lobster. And it's very difficult to catch these things, but there's a technique, and we can go over that on another podcast. Anyway, I'm under this bridge for 3 or 4 hours, and I see this gentleman just crushing, and he's renting jet skis by the hour. And it's like, I was there at maybe 6 a.m, and he was like unloading 4 jet skis off of a trailer. He had them under the bridge in the shade. He had them like kind of anchored up. And then it was just one customer after another I was fishing all day there, loading up on. You can catch 15 sheep's head in North Carolina per day, per angler per day. So I was just loading up for my mom a bunch of sheep's head, and I saw this guy just absolutely crushing it. And now, mind you, this is on like a weekday in the summertime. And I'm catching my sheep's head, and he's kind of looking at me like, oh, this dude knows something. And I'm looking at him like, this guy knows something. And we're kind of sniffing each other out. And I'm like, yeah, I'll trade this guy a little bit of sheep's head knowledge for what kind of business he's running. So we got to talking, and I said, how long does it take you to pay off one of these jet skis? And he's kind of like, well, that's kind of private. And I was, so okay, let me reattack on a different question, et cetera, et cetera. So he had a business that was returning excess of 50% on invested capital almost per month. He said that he could pay off a jet ski in the summertime in about 16 days, 15, 16, 17, 18 days, less than half, or like right over half a month. So think like two weeks and change, he could pay off a jet ski. So he would find these Yamaha jet skis on Craigslist that had low miles or low hours. He'd go buy a jet ski. He'd bring it down to Wilmington, North Carolina, and he'd rent it by the hour for $100, $250 on the weekend. And he'd just bang out. Now, the problem with that business, yeah, you're getting 50% on invested capital per year or more. The problem is he had no scale. He could only manage about 4 jet skis a day with, because he's got to sign these, he puts it up. He's got a little app on the internet, and he puts it up, and he's got to do all these waivers, this don't sue me. And he's like, basically I have an attorney on retainer. I pay him $5,000 a year. He writes up the liability waiver. And then if someone gets injured and they sue me, he, takes the case and he fights this thing out. We pay. I mean, he had insurance. It was all legal, but but he couldn't grow the business past, I don't know, 6-10 jet skis on a trailer and a truck. I mean, small business, but this guy was crushing it because he was getting something north of 50% on invested capital. What are your thoughts on that, Warner?
So you're talking about return on invested capital over a monthly period. Aren't we usually looking at return on invested capital over a yearly period?
That's right.
50% return on capital over a month is massive.
That's right. I mean, this is an incredible business he had. He was an incredible hustler, and he was Indian. He had probably come to America. I didn't get his backstory, but I mean, he was first or second generation India, still talking with an accent. He could have been running an Indian restaurant, and getting shut down by COVID or something like that, or the cerveza sickness. But instead, he executed a pivot drill, and he bought 4 Yamaha jet skis, and he's making excess of probably 100% a year. But yeah, you're right. I'm talking about a monthly. He could pay off a jet ski in 16, 17, 18 days in the summertime by renting it by the hour. So he goes out, he gets like a $3,000 or $2,500 jet ski, Yamaha jet ski, and he said, yeah, I took a course online of how to maintain like a jet ski, like how to know if the fuel's bad, if someone put bad or they left the fuel there, fuel filters. He could troubleshoot. So he could go out and buy a jet ski that had a dead battery and bad fuel, wouldn't start. But he knew, like, he could look at it and be like, oh, this thing probably has 10 hours on it, 50 hours on it. Throw the guy a couple grand, put it on his trailer, and then he just run the thing into the ground. He would just run these jet skis into the ground. I mean, every hour that things just get full out throttle. But he's like, doesn't matter. I can pay one of these off so quickly. Okay, you blow up a jet ski. You can blow up a jet ski every summer, and I'm still making money.
So then break down for the listeners with that example in the numbers that obviously this is kind of a guess or an estimation, the working capital piece, the fixed costs, and then the cash equivalents. If you just sort of game plan in your head, what does that look like with this jet ski business for our listeners?
Okay, so it's a pretty simple business. He has a truck that is a depreciating asset, and that's going to be included in the equipment of the business. And he's not making any money off the truck. I mean, he's just towing his jet skis from his property, wherever he lived, to the boat ramp, putting 4 jet skis in the water. The assets are actually generating the income are the 4 jet skis. So he's got trailer, truck, and 4 jet skis. I would call that plant, property, and equipment. There's that figure right there.
Okay.
That's plant, property, and equipment. Net working capital. Okay, so he's got fuel. I think he was the only he was the only employee, but he's got like net working capital. So he's got some capital in a bank account. So he's got his corporate or business account, probably in North Carolina. He's got that net working capital. That's the working capital he keeps in the business to buy fuel, to buy spare parts, to buy whatever he needs to maintain the
So
truck.
operational capital, if we want to put our
Yeah,
own little
yeah,
name on
you
it.
could call it that. I think the accounting term is net working capital, but yeah, short term
Yeah,
capital.
it is. It is net working capital.
Okay,
It's just for like nuts and bolts people. It's like your operational capital,
okay.
right?
So that's
Okay,
the
go
first
ahead.
thing he's got is net working capital. Let's say whatever that number is. Then you add the next thing, net fixed assets. So that's the truck, the trailer, and the jet skis. And then you minus excess cash. In his account, excess cash would be like, okay, I'm gonna keep this in short-term treasuries so I can pay my attorney. So every time I rent a jet ski, I'm gonna take $10 and I'm going to move it into a short-term treasury account or a money market account or something like that. I don't need it as working capital, but I need it in the business. I'm not going to extract it from the business because I might get sued this year. Somebody crashes on a jet ski and they break their arm, they go to the hospital and they sue me and we pay them out for the hospital visit. We pay them for the cast, et cetera, like that. So that would be what we subtract. Okay, so this is what is capital invested in the business. He's got net working capital. He's got his net fixed assets, PP&E, which is going to be those jet skis, the trailer, and the truck, and then we minus that account that he set aside for like an attorney. You know, his $5,000 a year retainer plus anything excess he's got to pay that attorney. That is capital invested in his business. Okay, that is your numerator. Correction, that's your denominator. That's your denominator. Your numerator now, so the top number, so we have the denominator, so we have what we're going to divide it by. The top number is going to be your earnings before interest and tax. That is going to be his operating income. So what is he doing per day? Well, let's just make this simple math, folks. This is math in public. Let's just say he's actually renting these jet skis for $110 an hour. Okay, that's his revenue he's taking in, and he's got $10 in gas, and let's just say the $10 is going to go into the business and disappear somehow. He's got per hour. That $10 is actually not going to be his to keep because it's going to be burned up in gas, etc. Now he's left with his operating income, which is $100 an hour times 12 hours. That's $1,200 a day. Okay, so now we're looking at, okay, you add 4 jet skis. He's doing, I mean, not every hour was he renting all 4, but I mean, it was people coming up. He was giving them their life jackets. He was giving them a quick class. They had to sign a waiver. I mean, he didn't have perfect efficiency. He probably could have hired one person just to be teaching life jackets and doing the waiver. And then he just put them on, give them a route, tell them to go up the ICW. The current's going this way. The wind's going this way. It's a funner ride, or it's a more fun ride to go south than north. But he had one employee. I mean, he was a solopreneur. Is that correct term? Yeah. So he just had one. He just had himself. He was a sole proprietor of his business. So very low employee costs. So yeah, I mean, this is a very interesting business. Now let's take Caterpillar. Let's take Caterpillar as another business. Now they have plants. They have massive plants to make those Caterpillar machines and diesel engines and equipment. They have these massive plants, and they have equipment in those plants. So they have plant, property, and equipment, and they're going to be way less than a 50% return on invested capital per year. But they've got massive scale. They've got massive scale. So there's a comparison. I would say you want to find something closer to what that gentleman was doing and buy that cheap. You want to buy that business, low cost business like this jet ski business or the app or whatever he was using, or this kind of think of that little business, but something that you could expand, you could grow, you could continually compound, you could get more jet skis and more jet skis, and you have more and more customers, and the brand grows, and you can keep doing that. That's the better business than Caterpillar. Because Caterpillar, one, they've already got almost as much market share as they can get. They've got Komatsu in Japan. They've got a few other competitors, John Deere in America, and they got a few players out in Europe. So there's 3 or 4 or 5 players in that space, and they've penetrated their market about as good as anybody in the world can do. They can't really grow more customers. Everybody that's a customer is going to buy one of those 4 competitors or themselves. So they're really just trying to get efficient. Now it's all about running that place lean and efficient and trying to grind out that return on invested capital, but it's way less than 50% a year. So I'm steering people, and myself, Warner, I'm telling you to find those businesses, the private businesses that are returning north of 50% on invested capital, returning that to the business or the shareholders per year. Over to you, Warner.
Yeah, so that's a great marker, 50%. We can even go down to say 30%, somewhere between 30 and 50%. If you had to think of it, the reason we're going this much in depth in terms of working capital, fixed assets, and cash equivalents is because when you analyze a business, you're going to go to this depth looking at their books. But if you want to just do it off of like the back of a napkin, here's a real simple way to assess it. If I put $100 in, how much do I get out? I mean, that's just like a long-term investor will do that type of stuff off like in the back of their head. Just real quick. Okay, I put 1,000 in, I get 100 back. No, that's 10%. It's not going to work. Okay, I put 1,000 in, I get 300 back. Ooh, that piques my interest. I get 400 back. Ooh, that piques. So that's a quick way to kind of look at it. Is just I put something in. What does it give back to me? And that's like the simplest way I can describe it. Thank you for listening to the Red to Black podcast. We really appreciate you taking time out of your day to listen to our podcast. If you would like to connect with us in the future, you can find us on LinkedIn. Simply search for Werner Minchell or Mario Parzino. Also, you can find a link to our LinkedIn profiles in the profile section of the podcast. Thank you again for listening, and we look forward to connecting with you in the future.